Let me ask you something. What if the moment you bought Bitcoin, the exact moment you hit, confirmed someone on the other side of that trade was already planning how to take it from you at half the price? Not illegally, not with a hack or a scam. Legally, structurally, patiently. That's what this video is about. And by the time you're done watching, you're going to see this market completely differently. Here's what most people are staring at right now. Bitcoin hit all-time highs. The ETFs launched. BlackRock, Fidelity, the big players are officially in the game. And yet the price has been grinding sideways, getting rejected, bouncing around, refusing to break out. And the question everybody's asking is, why? If institutional adoption is real, why isn't price reflecting that? Why does it feel like something is pushing back? I've spent a long time looking at how powerful financial institutions move markets, and what I found isn't a conspiracy theory. It's a playbook. One that's been used for over 100 years on countries, on companies, and now potentially on the largest Bitcoin holders in the world. Let me start somewhere that's going to sound off topic. Bear with me. Back in the early 1980s, a wave of developing nations found themselves drowning in debt, not their own currency, someone else's. They borrowed dollars to fund growth, roads, factories, infrastructure, and for a while, it worked. But there's a specific kind of vulnerability that comes from owing debt in a currency you can't print. The second interest rates rise, the second the dollar strengthens, the math turns against you fast. Several of these countries watched their debt payments nearly double overnight, not because they borrowed more, but because the currency they owed got more expensive. And when they couldn't pay, international lenders showed up with what they called rescue packages. Real talk, those packages weren't rescues. They were acquisitions. State assets sold off. Markets opened to foreign capital. Sovereignty quietly transferred through a contract. Here's what I want you to take from that story. The mechanism isn't violence, it's structure. You engineer the right financial trap and you don't need to force anyone to do anything. The math does it for you. Now, let's bring that home. Say you own a house worth $500,000. You pull out $100,000 in home equity at a variable rate. Payments are manageable, maybe $400 a month. Fine. Then rates move. Suddenly, you're paying $900, then $1,100. Your income didn't change. Now, you're not making a decision based on what's rational. You're making a decision based on what's urgent. Sell at a loss, refinance at terrible terms, or default. All three options benefit the lender, not you. The bank never broke the law. It just designed a situation where your desperation was inevitable. Now, scale that up. Replace the house with $45 billion worth of Bitcoin. Replace the home equity line with $16 billion in convertible bonds and preferred shares. And replace you with a publicly traded company whose stock price is the only thing keeping the whole structure from collapsing. That company is real. Strategy, formerly MicroStrategy, has accumulated roughly 450,000 Bitcoin. At current prices, those holdings are worth somewhere around $45 billion. They paid about $27 billion for it. On paper, they're sitting on a massive gain. But here's what's underneath that number. The convertible bonds and preferred shares they use to fund those purchases come with obligations. Preferred dividends aren't optional. If you miss them, you're in default. Right now, the total cost to service that debt and those dividends is somewhere around $700 million a year. That's close to $2 million a day, every day. Their core software business generates maybe $100 million in free cash flow annually. That's not even close to enough. So they've built a cash reserve roughly $1.2 billion specifically to cover these obligations. At current burn rates, that's about 20 months of runway. That number matters. Remember it. Here's where the structure starts looking dangerous. Strategy's stock trades at what's called a premium to net asset value. Basically, if you add up all their Bitcoin, subtract all their debt, you get the real worth of the underlying assets. But the market has been valuing the company higher than that, sometimes significantly higher. Why? Because investors are paying for the belief that they'll keep buying more Bitcoin and that Bitcoin keeps going up. As long as that premium holds, the flywheel works. They issue shares, raise cash, buy more Bitcoin. Bitcoin rises, stock rises, repeat. But the moment that premium disappears, the moment the stock starts trading at a discount to its actual assets, the whole machine stops. Because selling shares when you're trading below asset value is like selling Bitcoin for less than it's worth. You stop issuing equity, the flywheel locks up, and now that 20-month cash reserve is the only buffer between Strategy and having to sell Bitcoin to pay its bills. If they sell Bitcoin, price drops. Stock drops further. They need to sell more Bitcoin. Price drops again. That's the spiral. Now here's the question that keeps me up at night. Who benefits if that spiral starts? I want to be direct. I'm not claiming I have proof of a coordinated scheme. What I'm saying is that the incentive structure exists. And when incentive structures exist at this scale, they tend to get used. Think about who's on the other side of this. Major institutions, pension funds, sovereign wealth funds, endowments, they want Bitcoin exposure. They've wanted it for years, but they can't just go buy it on an exchange. Too volatile. Regulatory complications, custody issues. What they'd love is to buy Bitcoin at a discount, 15–20% below market, through a proper counterparty in a structured transaction with all the paperwork in order. And if strategy ever gets pushed into a distressed position, if they're forced to liquidate positions quickly, they're not going to dump billions of dollars onto retail exchanges. They're going to call 3 or 4 major banks and say, "We need to move this fast. What's your bid?" And those banks are going to say, "We'll take it. But we want a discount for absorbing this volume." Suddenly, the people who spent months applying pressure to strategy's stock have just bought billions in Bitcoin at $70,000 or $75,000 a coin. Legal, clean, profitable. I need to stop here for a second and tell you something personal. A few years back, I was in a situation where I was underwater on positions I believed in. Fundamentals hadn't changed, but the price kept moving against me, and I made the worst decision you can make in that situation. I sold. Not because I stopped believing in what I owned. I sold because the pressure became unbearable. Because I was watching numbers every hour. Because the psychological weight of holding something that keeps going down even when you're right about the long term is genuinely brutal. I sold, and then watched it recover. And I had to sit with the specific kind of pain that comes from being right about everything except your own emotional limits. That experience taught me something I couldn't learn any other way. Manufactured pressure works. Not because investors are stupid, but because humans have a pain threshold, and sophisticated players know exactly how to find it. Here's something from the early 2000s that I think about a lot. There was a financing structure called a floorless convertible, basically a hedge fund loans, a struggling company, cash, and instead of getting repaid in dollars, they get repaid in stock. The catch: the lower the stock price, the more shares they receive. Think about that incentive for 1 second. The lender profits more, the lower the stock goes. So what do you do with the stock? You short it, you spread uncertainty, you apply pressure. The SEC looked into hundreds of these deals. The average company that entered into one saw its stock fall 34% within a year. Nearly half were eventually delisted entirely. Not fraud, not illegal, just a structure where someone else's collapse was your gain. Strategy doesn't have floorless convertibles. But the psychological dynamic, a large, structurally constrained holder being squeezed by entities who profit from their distress, that dynamic is the same. Now let me tell you what this actually means for you if you own Bitcoin. First thing, strategy is not Bitcoin. If strategy runs into serious trouble, it's a story about one company's capital structure decisions, not a verdict on the underlying asset. Keep that separation clear in your head. Second, what does it tell you that major institutions are running these plays? It tells you they want Bitcoin. They're not ignoring it. They're not dismissing it. They're engineering ways to accumulate it cheaper. You don't build complex financial pressure campaigns against assets you think are worthless. You do it against assets you want to own but refuse to pay full price for. Third, watch strategy's quarterly disclosures. The cash reserve is the real signal. As long as they have runway, the death spiral thesis is just speculation. If you see that buffer actually starting to deteriorate, that's when the math changes. Fourth, and this is the one that matters most, your only real defense here is understanding the game well enough that you don't get played by it. The wealth transfer that happens in volatile markets isn't usually through fraud, it's through psychology. One side panics at the exact moment the other side is accumulating. Retail sells at 85,000. Institutions hold it and distribute it later at 150. This cycle has repeated across every major asset class for as long as markets have existed. Here's what I'll leave you with. The question you need to answer for yourself isn't what's going to happen to Bitcoin next month. The question is, do you actually understand what you own and why? Because if you do, if you've thought through the scarcity argument, the monetary policy argument, the global adoption curve, then short-term manufactured volatility isn't a crisis. It's an entry point. And if you haven't thought it through, then the volatility you're experiencing isn't manipulation. It's just the market teaching you an expensive lesson about position sizing. Understand the structure, understand the game, and when the pressure shows up, and it will, you'll know exactly what it is and what to do with it.